Welcome back to the Income Generation. I'm here, of course, with my good friend and co-host Jeff Small, as well as our good friend Michael Stewart in his fancy corner office, as you could see, founder of Crystal Lake Tax and Financial, a retirement income store located outside of Chicago, Illinois. So I think that's a good point, Jeff, when you talk about the fact that some of these, even though the stock market's hitting new record highs, more than half the stocks are still down in value. A quarter of the stocks in the S&P 500, a quarter of the weighting of the S&P 500 index is due to 7 big technology stocks. So majority of stocks are still down and still have good opportunities. Isn't that right, guys?
I agree with you, Dave. One of the things the opportunities, really, I think there's 2 parts of it that we've been sharing with clients, especially as it relates to dividend-paying stocks, is one, identifying good quality companies that have really low bond yields right now, but their stock dividend yields are significantly higher. Because if there's a low bond yield for a good quality company, that means it's probably good credit. It's mean they're financially strong. That means the dividend should be stable. So if you have the opportunity, like we've been looking at a pharmaceutical stock that is paying about 2% for their bond, but their yield is about 4 to 5% on their stock, and it's something that's still down for the year. So it'll participate in what Jeff was talking about, kind of that catch-up trade as the economy continues to improve. But in the meantime, you're earning twice the yield at the same time.
Sure, yeah. And it's a bond proxy, because at the end of the day, when corporations can borrow at such a low interest rate, can deduct the interest, it's almost like free money. So why not go ahead and take that money and they could support their dividend, which is what's been happening. But also, guys, what if this recovery did get ahead of us in the stock market? And what if, Jeff, you're wrong, and let's say we do have another drop in the market because the market's finally realized that unemployment's going to be double digits for a while to come. Then, how about the opportunity to be a capitalist upon the next market drop? As opposed to the market drops, you're a victim, not having all your money in dividend stock strategies, having your money in other stuff, so now you can buy those stocks when they're on sale. How about that, guys?
Well, I think that'll work, Dave, but it's really hard. That's like us being tactical. It's very difficult for individual investors to be tactical. But there has to be a reason for a sell-off. So what would cause the reason for a sell-off? Let's say hospitalization rates go through the roof and they're overrun, or mortality starts to skyrocket, or the phase 3 clinical trials on the 3 real potential vaccines that we have all have bad news and they don't go to FDA approval. These are all things that can rock the markets.
Or unemployment rate stays in the double digits through the end of 2021, and because certain industries don't come back fully, and then the market starts to realize that. So bottom line, nothing that we talk about today is the be all and end all. Just like you shouldn't have all your money in bonds and bond-like instruments, you shouldn't have all your money in dividend-paying stocks. And I know all 3 of us agree with that. So gentlemen, thanks so much. It's been great having this 3-way conversation here. And you stay with us. We have more to come right here on the Income Generation. We'll be right back.